If you're a Canadian investor, I need you to listen up because one of the best opportunities in the Canadian markets right now might be going right under the radar. And it's all about the Canadian oil and gas sector, an industry that, while politically divisive, has a lot of opportunity right now for investors because it has pushed away so much investment, both international and domestic, over the last 10 years. And now all of a sudden, investment is flooding back into this industry. We've seen a wave of mergers and acquisitions, and we're starting to see real questions being brought up about the value of assets in this industry. And we've seen that value start to be unlocked in some of these publicly traded companies. This means that for us as regular retail investors, we could be looking at significantly undervalued assets that pay great dividends with big growth potential over the next 5 years. And when you see those assets, you jump. Today specifically, we're going to talk about one of the big names that made a big splash earlier in this year with an acquisition. We're talking about Whitecap. And this company has been just absolutely in the news thanks to their merger with Valuation. These two were sort of middle of the road, mid to small cap Canadian producers, but have combined to create what is now the 7th largest producer. Part of this merger was all of the potential synergies and all of the opportunities that these two companies could bring each other. But another big part of it was the investment opportunity that this combined company would offer to big funds. When you look at it on a sort of general sense, the Canadian oil and gas industry is still struggling to attract major institutional investment. And as more and more institutional investors start to look at this industry, companies like this that have suddenly gotten large enough that institutions can own a meaningful stake without hitting any sort of, limits as to how much of the company they can own or how much of their portfolio it has to make up, all of a sudden, big opportunities open up. We see a lot more money unlocked, and we could see valuations start to improve. So today we're going to talk about Whitecap Resources and whether or not this company is undervalued. And I'm going to walk you through some really insightful analysis on both the merger itself, but also the potential opportunity of this company. On the screen here, I have an article from Synergies Resources. I think I'm saying that right. This person has covered Whitecap for a little while. They rate it as a strong buy, and they have some interesting things to say, and I want to share them with you guys. So, of course, Whitecap Resources undervalued post-Valuation merger, right to the point. Obviously, the author thinks this is undervalued. Summary, if you're just looking for the summary here, they completed their merger with Valuation just last month, May 2025, forming Canada's 7th largest E&P company. They expect the large, low-cost asset base to benefit from their positive outlook on commodity prices through the end of the decade. So we're not talking, massive shift in a year. We're talking 5 years here. We're talking, the end of the 2020s. This thing could be structurally different. It could be valued on a whole different level. I agree with that. I've been saying, I think Canadian oil and gas is undervalued as a general industry. Their DCF model supports a fair value of $12.50 or $12.30 per share, which is materially up from the price of $6.25 at publication. That's double. And remember, that's a fair value. So if we're saying that the industry is suddenly going to re-rate, you can see a triple. You can see more than a triple. Again, not this year. This is not a moonshot. This is not a meme stock. We're talking 5 years, but still, if you're looking at a commodity stock and you think in this cycle you could triple, I mean, it's worth a look, right? Obviously, key risks include the challenges of the integration with Valuation and geographic concentration in Canada. Now, I'm going to walk you through this article. I should state my bias here. I am very bullish on the Canadian oil and gas sector. I think natural gas has a great sort of next 2, 3, 4 years from a stock market perspective, because the next 5 years will be great for the industry. And we'll see the most gains made, I think, 25, 26 into 27 in natural gas stocks, with then Canadian oil stocks sort of beating out natural gas into 2030. So while natural gas probably is going to get a head start, I think Canadian oil is going to catch up through about halfway through this next 5 years. And then we should see Canadian oil outcompete into 2030, thanks to a whole bunch of different factors that we talk about often here on the channel. If you disagree, you're allowed to. That is very fair. As an investor, you shouldn't put your sort of beliefs ahead of the facts. And when facts change, opinions need to change too. But that's just what I see based on all of the analysts that I have read, all of the articles that we've gone through, all of the news we've watched, all of the big catalysts coming online, and all of the sort of trends in the industry. That's what I see going on here. So That's the bias that I'm coming at this with. Introduction. Dust has settled after the Whitecap Resources and Varen merger closed on May 12th of 2025, and I find the resulting company materially undervalued. The new Whitecap is the 7th largest producer in Canada, current production of 365,000 barrels of oil equivalent per day, has a large inventory of unconventional assets with nearly 1.5 million gross acres in the Montney and Duvernay, along with over 3 million gross acres in low decline conventional plays across Alberta and Saskatchewan. So it has some great assets there. The 3 million acres of low decline conventional plays, I think that's what's probably the most structurally undervalued, because that is going to outlast some of the shale stuff going on. And it's going to outlast US shale's peak here over the next couple of years, and then suddenly going to be way more valuable when suddenly the growth engine that has been the United States, and particularly the energy demand growth, suddenly looks and says, hey, we need more conventional energy, to use the current term for it. And then all of a sudden, those 3 million acres are going to be worth a lot of money. The 1.5 million gross acres in the Montney and Duvernay, that's going to be the next couple of years. That's going to be the growth engine in the shorter term. Because the Montney and the Duvernay have great opportunity right now, particularly with things like the LNG Canada coming online. All of a sudden, all this natural gas is getting moved. The prices are going up, right? So that basin is also seeing a structural re-rating and valuation. While Canada has elevated regulatory risks and infrastructure constraints in comparison to the US shale basins, 100%, the Western Canadian Sedimentary Basin, including Whitecap's asset base, is attractive due to its low cost of supply and large inventory. These qualities provide a solid foundation for Whitecap Resources to benefit from my outlook for higher oil and natural gas prices through the end of the decade. There are several reasons for my positive outlook on commodity pricing. For natural gas, I expect the upcoming increase in North American LNG export capacity will begin to close the global arbitrage on pricing. Same unit of natural gas in North America can be worth several more times in Asia or Europe. Oil prices have been pressured in the near term due to trader uncertainty, fear of recession, and the overhang of increasing OPEC plus production limits. I'm going to put a little pause here. I think it's really interesting, the story of OPEC plus production increases, because yes, okay, they have increased a lot, but when you think about the price of stocks specifically, part of the risk premium you put on these stocks has been the idea that, well, oil is really quite volatile. It goes up and down dramatically, and it can be moved artificially by this big block. And them having all this spare capacity added a risk premium to these stocks. So depress the value of oil and gas producers by a certain amount. And it might have only been a few percentage points or a few, maybe a point of PE. But that's still a point of PE. And then as that extra potential starts to go away and is realized, you're probably going to get an evening out where at some point they can't really mess with the price too much more because they don't have that overhang and that leverage on the market. I think it's interesting. However, the author believes that US shale is maturing and expect production to plateau and eventually decline at current investment rates. I believe that as well. I think that's a big part of why OPEC is raising the price, because they can sort of undercut the US shale oil industry at a time when they don't have the strength they had last time. Again, there's this sort of, I would say, maybe not repetition of history, but a little bit of a rhyming pattern here, where we saw Saudi Arabia and OPEC Plus in general try to really push out US shale back in the mid 2010s when US shale was starting to boom. And at that time, US shale was such an opportunity and there was so much money willing to be invested, and interest rates were so low that they could just borrow money and they could just, they promised the moon and they delivered. I mean, they grew the US to be the #1 oil producer on earth. Now that we're at a different point of actual geology, according to people as influential as the former pioneer or former CEO of Pioneer, who was a pioneer in the industry himself, saying, hey, yeah, okay, we don't have the geology. We don't have the actual oil in the ground right now. We're going to be pulling out way less valuable stuff, and we can't do it at this, this price. It costs so much for us to do this. We're only getting so much. Well, all of a sudden that OPEC plus move makes a lot more sense, and maybe you're going to see a different result. Now, we're never like 100% sure. It's never a sure thing whether or not this sort of trade war stuff works out from the perspective of OPEC plus, but really interesting that we're seeing this rhyme in history, but it's going a whole different way. While I expect there to be incremental, we're back to the article. While I expect there to be incremental volume from OPEC plus, portion of the increase is already accounted for by some members exceeding their targets. True, there's a lot of people cheating on OPEC. Specifically, I think they've blamed a lot of it on Kazakhstan and Iraq. If OPEC plus voluntary cuts unwind and there's continued underinvestment by the industry, I believe global supply will become more inelastic and lead to higher average prices. And then we get actually a pretty interesting thing. Look at the map here. I like this. We see the unconventional in blue. This is the Montney and Duvernay, and the conventional in green. So you see it across Alberta and into Saskatchewan. And you can see, like, we're not talking a small amount of land here, right? This is the kind of thing, if you zoom out far enough, you can see this from space. Whitecap Vin merger. The merger was valued at approximately $11 billion US dollars, was an all-stock transaction where Vin shareholders receive 1.05 shares of Whitecap for each share of Vin. After the transaction, Vin shareholders own 52% of the combined company, but it'll be led by Whitecap's management team. There was some drama about this when it came out. We saw some pretty influential people actually sort of cry foul, being like, hey, why does Whitecap get to lead this thing? Why does their management get it? As a retail investor, I don't know that it matters to us, but some people cared. So who knows? Who knows? I don't want to speak to that. During the M&A announcement, Whitecap indicated an expected US $146 million in annual synergies, in addition to being immediately accretive to funds flow per share by 10% and free funds flow by 26%. Few of the key areas that contribute to synergies are adjacent and overlapping acreage. Huge. We talked about this just the other day when we talked about ARC Resources and their acquisition. When you can just combine the actual day-to-day operations, you save so much money on these kinds of projects. You don't have to duplicate everything. And again, we're talking acres, millions of acres. So there's a lot of expense that goes into just taking care of everything going on. And there's a lot of very technical work being done by a lot of people. And having that combined makes sense from a cost perspective. There's also operating capital efficiencies due to increased scale. True. General and administrative reductions. You don't have the duplicated management, for example, and an improved credit profile because they're larger. Their fund flow is bigger. They can probably borrow money better and they're more investable. I did not find the merger to be immediately accretive to Whitecap on a 5-year discounted cash flow basis, excluding synergies, but the difference was not significant enough to outweigh the benefits that I expected to be realized from an increase in scale and long-term efficiencies. So while there might not be, a huge amount of immediately accretive sort of synergies, there is a significant amount of increase in scale and longer-term efficiency. Valuation. Using a 5-year discounted cash flow DCF model, I estimate a fair value of US $12.30 per share for Whitecap after the merger. I modeled production using the midpoint of the post-merger guidance of 297,500 BOE per day starting in Q2 of 2025 and assumed a 6% compound annual growth rate for the remainder of the model. While this assumption is more conservative than their historic growth rate, it assumes the increase in scale will lead to a growth that is closer to members of their peer group, such as Tourmaline and ARC Resources. The resulting cumulative production of the 20-quarter model is 609 million barrels of oil equivalent. I assumed average benchmark prices over the period to be about $75 for WTI oil and $4.75 for Henry Hub natural gas, and use a regression analysis of Whitecap's historic realized pricing to calculate a revenue estimate of $30.4 billion for the period. While these benchmark averages are higher than the near-term strip pricing, they reflect my bullish outlook on oil and natural gas over the next 5-year period, which we have talked about. The unit operating costs that I used are included in the table below and result in cash operating expenses and income taxes of $16.4 billion. So you look at all the expenses here, and they calculate a cash flow of $11.8 billion, $9.2 billion discounted to the present, assuming a 10% weighted average cost of capital, by subtracting cash operating expenses and taxes, subtracting capital expenditures, and adding non-cash expenses to total revenue. The assumptions for capital expenditures of 30% of revenue in the model aligns with estimates from Whitecap's latest investor presentation, and this is in line with historic values. Use an exit multiple of 4x enterprise value to EBITDA over the trailing 12 months to determine a terminal value of US $13.9 billion, US $8.5 billion discounted to present. By adding the sum of discounted cash flows and terminal value, I obtain an enterprise value of $17.6 billion US dollars and an equity value of $15.1 billion after adjusting for net debt. using assumed share count of 1.2 billion shares, provided my fair value of $12.30 per share. Good math. Since Whitecap is sensitive to commodity price volatility, I'll also calculated low and high average benchmark pricing DCF scenarios using the assumptions in the table below. So we see a low case, we see a base case, we see a high case. And obviously, in each case is going to dramatically impact a couple different things. We see, $55 oil over 5 years. I think that's brutal. High case, $90. I think that's also kind of brutal for the consumer and for the economy to have $90 oil for the long term. That'd be expensive. Base case is probably where we want things to be. We'll see. If we're really deeply invested in oil, obviously we'd like the oil price to be higher. But as somebody with a diversified portfolio, we want to see the economy trucking along, and that needs oil in that sort of 70 to 90 range. In my personal opinion, obviously. The results of these scenarios are in the table below. And so you see I'm going to sort of zoom through here and just look. So low case, fair value per share, tough break here, $4.76. Base case, of course, that's the double up, $12.30. High case, you're looking at $23.88, which again, this is a $6 stock. We're looking at the US ticker. This article is sort of focused on the US ticker. But $23.88 from a let's just say $6 and a bit stock is just about 4x your money. I mean, hey, in 5 years, would you not want a 400% gain? At least with a chunk of your portfolio. I'm not saying, don't YOLO 100% of your portfolio ever into something. But I mean, it's interesting. It's an interesting opportunity. And again, this is not some pie in the sky growth stock valuation. We're talking a discounted cash flow. Yeah, okay, some of the assumptions are a little bit hopeful, but there's no reason we couldn't see at least some of them come true. Let's talk some risks. Obviously, there's some cyclical risk, commodity price risk. They hedge 25 to 35% of production volume to reduce downside risk, but also that limits upside during favorable pricing environments. Hydraulic fracturing is key to future development for Whitecap and is subject to particular regulatory challenges in addition to risks related to water usage rates, waste disposal restrictions, almost couldn't say that, and seismicity. A key company-specific risk for Whitecap is the successful integration of Valuation to ensure operational execution and the realization of the merger synergies. Whitecap's operations are entirely concentrated in Canada, which, let me just say, I love. I am specifically bullish on Canadian oil and gas. I'm not all that bullish on in sort of the global industry. I just think Canada has a sort of asymmetric opportunity. So I'm happy to see a company like this, but obviously it presents some geographic risk. And they also face foreign exchange risks due to the revenues being denominated in USD and costs being in Canadian dollars. So their merger with Valuation creates a large cap Canadian E&P with deep inventory in two of North America's premium unconventional plays, the Montney Duvernay, along significant low decline conventional acreage. My base case discounted cash flow supports a fair value of $12.30 per share based on my fundamental analysis of the company and positive outlook for oil and natural gas pricing. But I expect that Whitecap will have to execute operationally for several quarters for the valuation to be realized. So I think it's crucially important here that we consider just what the opportunity is here for Whitecap. It's a stock that's kind of been caught up in this idea that maybe this merger was a challenge for them. Maybe there was something up with it. There were some stories, there were some bad headlines, and it happened at a time when there's so much uncertainty. And so a lot of investors that were, maybe on the outside looking in, they had their toes in the water, let's say, suddenly took their sort of chips off the table. They're like, yeah, no, I'm not interested. I'm going to go play in either a safer Canadian oil and gas play, or they're not going to play in the pool at all. They're going to get out. They're not interested in being in this industry. They want it to be somewhere else. I think over time, as we see two things, first is going to be some good results. And second is going to be really clear and solid guidance about what this merger has meant. And I don't mean what they expect it to mean, but what it has meant for things like synergies, for long-term capital. And crucially, this is what I'm really interested in, for investability. Are we going to see big companies take a stake here? I'm not necessarily talking the kind of thing we're seeing with Meg Energy and Strathcona Resources, where all of a sudden there's these hostile takeover bids that jump the share price because suddenly investors realize what they're sitting on. But you could expect to see somebody big want a share here. Remember, we're talking of not only millions of acres of unconventional Montney and Duvernay assets that are super valuable, that shale oil US players are probably going to look at and be like, holy, Look at this giant investable basin right up there with good connectivity down to the US that can support our existing LNG industry. I mean, hey, Canadian Natural Resources got a 15-year deal. Maybe some of these US companies are going to want to be in on the action up here. But also then you're looking at 3+ million acres of conventional, low decline, really solid, really valuable, great traditional Canadian oil assets. You're going to see somebody want to own this thing. That's my prediction. I think you're going to see somebody want to own this thing. And I'm hoping, for the sake of us as retail shareholders who want the opportunity to invest in some of these companies, I'm hoping it's in the public markets. But you might see a takeover bid, right? You might see a similar story where a lot of the potential undervaluation gets realized overnight. And you see a 20, 30, 40% gain overnight because somebody realizes what the stock is actually worth and they start paying it. And that's about all I have for you folks today. I hope you enjoyed this video. I hope you learned a little bit, or at least I hope you are going to sort of take a look at some of these smaller Canadian oil and gas names, because I think there's some real opportunity there. I've been a big investor in some of the bigger names, but I think it's worth, just those few percentage, those extra pieces of your portfolio. I think it's worth looking at something like this. It doesn't have to be this one specifically. There's lots of opportunities, but I think it's worth looking at some of these smaller opportunities that could net you 400% over the next little bit. If you put 2, 3, 4% of your portfolio into something like this, and you do see that 400%, it's huge. It's awesome. And you're mitigating your downside risk. And that's the kind of direction that I'm looking at this. But let me know, what do you think? Are you invested in this? Would you invest in this? If you're not, are there other plays that are similar that you think we should compare this to? I think there's a couple that I've got off the top of my head, but I'd love to hear your thoughts as always. And of course, if you've got a company you want me to cover, please do let me know down in the comments below. Got a couple of videos in the pipeline here from viewer-specific requested comments, and I'm really interested in sort of covering what the community is interested in. And as always, we talk about investing in Canada every day here on the channel. So please do like the video, subscribe to the channel, and I will see you in the next one.